I mean, obviously, a couple of major announcements. The travel ban to Europe, which is going to be significant. Lending by the SBA, the first thing that comes to my mind is how long does that process take? On top of it, what you're asking the average small business owner is to take on additional debt at a time in which they're struggling. So if you're talking about a restaurateur that happens to have a restaurant next to a Apple campus, for example, and Apple is asking all of their employees to work from home, you're asking them to take on more debt. That really doesn't make a lot of sense to me. That would be a stimulus to our economy.
And so the market's reaction, wild swings in a matter of 5 minutes from flat down to 350 now for the Dow. What does this mean in terms of how the markets will take to the announcement? Are they expecting more?
You know, right now what we're dealing with is a market that we've never seen before. We're seeing unprecedented volatility. We're seeing a drop in the market, and the velocity of that drop is very, very significant. What we really need is some consumer confidence, because if you do not start to stimulate the economy in a way that actually gets people to go out and feel safe to spend money, 70% of our economy is based upon consumers. And so if those consumers are being sequestered away in their homes, they're not going to spend the same way that they did before. They may be spending online, but a lot of it is being spent on basic goods, the kind of hoarding mentality that you've seen at places like Costco and Walmart, where they're stocking up on soup and they're stocking up on toilet paper, and they're not going out and really spending on discretionary items that would really be the driver that could keep us from going into recession if we're not already there.
Jeff, do you think a tax holiday is going to resolve that concern with the consumer? Once again, Trump says he's instructing the Treasury Department to defer tax payments without interest or penalties for certain businesses, but also individuals impacted by the coronavirus. But few details on how they're going to pay for this yet. I mean, we heard from Larry Kudlow, they're hoping that a tax break would do precisely what you're suggesting, encourage more spending, will result in more growth. Do you think that will be the case?
You know, I love the idea of getting rid of some of the taxes to small businesses. If we got rid of the 6.3% tax that's a small business owner is incurring, that's money that's going directly back into their pocket, allows them to have more employees, allows also the employees that are also getting matched in the same situation to have more disposable income at their beck and call. So yeah, something that would be putting money directly back in people's pockets easier. I mean, going through the SBA process is not an easy process in and of itself to begin with. It's typically a 60 to 90 day time period in which you can actually get lending. So unless they cut that red tape out and they don't make these business owners jump through a lot of hoops, being able to access that money is really not the stimulus. A tax cut definitely would be, and it would be something I think that would definitely give the markets more reason to stabilize in this level right here. Whereas right now, there's just so many unknowns that the market is really kind of washing out across the board. A lot of it being an index share, so you're seeing a lot of even the defensive areas of the stock market getting hit just as bad as overvalued parts of the market, because people are selling their S&P 500 index share, which means that they're selling everything in the market rather than just specific segments within the market.
Well, Jeff, and that's what we appear to be seeing still. I mean, we're talking about the fact that these measures are meant to stabilize the markets, but we're seeing some pretty indiscriminate selling in the Asia session as we watch those U.S. futures move lower. I can tell you Asia ex-Japan now overall at the lowest level since early January 2019. You can see the Nikkei 225 moving further to the downside since this show started. So what was in that presentation that didn't relieve markets? I mean, do you think what many might perceive as an extreme measure in limiting travel from all of Europe just hits at the fact that recession risks could be growing?
Well, I think that one of the things you got to really look at is what actually has been going on versus what the president is talking about doing. You know, yes, we did limit our travel to Asia at a time that made sense, but we also are lagging a lot of things like testing equipment. And so when you're lagging testing equipment, how do you really know how widespread the coronavirus has spread inside of the United States? Most of what we're hearing out here is to expect those numbers to go up significantly in the coming days as more tests are made available. school closures, other things, those are all hitting productivity as well. So if you've got your kids at home and you're forced to work from home, you're not going to be as productive as if you're sitting in your office doing regular work. So there's a number of other obstacles that are out there. This is definitely a pandemic, and that pandemic isn't always solved just through financial stimulus. You really want to be able to calm the nerves of the people and have them have much more concrete evidence that we are containing this in some way, as the Chinese did about a month ago.
Well, that indeed is the case, Jeff. But to Nancy's question once again, because now we are staring down the barrel almost nearly 500 points on the Dow Jones. What was missing in his statement? And do you think that that whole issue with the travel ban on Europe for the next 30 days means that supply chain, especially impacting the auto sector, food chain, as well as the medical industry, is where there would be significant setbacks, and that's what the market is worried about because it's so core to the economy?
Well, I mean, if you're looking at it, taking the entire EU on its own, it's the same size as the U.S. economy. So you're basically banning the United States from being able to travel and do business with what is equally as large of an economy as our own. China is obviously substantial as well, but China was already shutting down some to the United States with their own measures. This is an unprecedented move. So while I certainly think that it may help in the contagia side of things, it is an extreme measure, and I think that the markets are going to have to digest exactly the impact to the local economies, the U.S. economy in and of itself. Stimulating local economies and so on is done at the ground level. It's not done through giving local governments money. It's by actually feeding the small business owner, the mid-sized business owner that's employing anywhere from 5 to 100 people. That's where you're going to start driving business.
Yeah, no, but to that point about how, essentially leading to more debt issuances to the small scale, the small size and mid-sized businesses does not really solve the concerns that there are with rising default risks in that particular segment of the market. But you are continuing to be defensive in this sort of an environment. Do you think the consumer will continue to hold up at a time when there's so much uncertainty?
Well, right now, because we don't really have a full understanding of the impact of the COVID virus in the United States, the market drops that are going on are purely sentiment-based. And so obviously we understand that there have been disruptions to supply chain and those things, but we haven't seen an earnings season from where it's actually happened in the United States. So the drop, the 20% drop in the Dow, the 19% drop in the S&P 500 is all driven based upon speculation of what is expected to happen versus what's truly known right now. A few of the leading economic indicators that we're getting are showing weakness. They're certainly not pointing 100% into recessionary levels, but they're very close. And so unless we can get sentiment solved, calming the nerves of the average person out there, the markets are going to continue to be volatile. You have some relief rallies, you're seeing selling into those relief rallies, and you're finding new lows. So to me, we're not going to get excited about getting into this market until we start to see that the COVID virus has had its run, that we're starting to see the number of cases in the United States at least flatline, not being an upward spike like they are right now.
And Jeff, I just want to bring up treasuries as well, because in anticipation of this address from the president, we had actually seen some selling of treasuries, an uptick in treasury yield. So if we can just bring in the latest check here, I want to bring to our viewers that the 10-year is now at 0.7635. So that is somewhat of a change from the 0.814% that we had in the session yesterday on Wall Street. And this raises the issue, Jeff. I mean, you're waiting to get into equities, but are you making any moves when it comes to fixed income?
Yeah, so I mean, our flagship strategy is a balanced strategy that ranges, typically it's going to sit about a 60-40 split of stocks to bonds. Right now we're sitting at 37% stock, we're sitting about 35% bonds. So we're not fully invested in the fixed income markets, but we're there. And that's been a lot of the mitigating factor that's helped us relieve some of the downside within the markets. Today's market, yesterday's for you, today's for me, that market, you saw stocks drop and you saw bonds drop, exactly what you were describing before. So you really had a baby in bathwater selling in this market that we're seeing right now.
Jeff, great to have you on the show. Thank you very much for your time, and thanks very much for giving us your insights.
Well, let's move on, where the World Health Organization has now officially called the coronavirus outbreak a, quote, pandemic. Now, this comes after the number of cases outside of China climbed 13-fold over the past 2 weeks.
We're deeply concerned both by the alarming levels of spread and severity and by the alarming levels of inaction. We have therefore made the assessment that COVID-19 can be characterized as a pandemic.
And Italy shutting all shops now except those that sell food and medicine as the number of cases continue to spike. The country has reported more than 12,000 infections, and that is a big worry for Europe. German Chancellor Angela Merkel has warned that up to 70% of its population may be at risk. Right here in Asia, South Korea is trying to contain the spread of the disease with the discovery of a new cluster in Seoul. The country just reported 114 new cases this morning, bringing the total to over 7,800.
Pandemic it is then, making it a global worry. Up next, time now to take a very short break, but coming up will be Hong Kong and mainland China markets. We'll get you the opening ticks in just 2 short minutes. Don't go anywhere.
is CNBC Breaking News. Market sell-off.
Greater China markets opening red across the board after President Trump spoke about COVID-19. U.S. futures accelerating its losses, and we are seeing red across the board. We've got the Shenzhen Composite down 1.6%, Hang Seng Index down 2.5%. Certainly bigger stress when it comes to the Hong Kong stocks. Flip the board and let's check on the currency board. As we speak, and of course with the market volatility, we are hearing from the likes of Nomura calling for a triple R cut over the next few days. And we do see continued haven plays perhaps for the U.S. dollar, currently trading at 6.9828. So certainly the CNH is weaker at this point, and we'll wait for the CNY spot rate to kick in as well. Here in Hong Kong, like I said, steeper losses coming through for the Hang Seng Index. And let's check on some of the top heavyweights to show you where that weakness is coming from. Tencent Holdings down as much as 2.7%. HSBC down 1.5%. And of course, we heard from AIA Group this morning about 2019 full earnings, and that is reflected in the stock performance down 3.5%. There was that COVID-19 related warnings as well, talking about that uncertainty when it comes to the recovery and potential long-term impact of coronavirus on their business as well. In the meantime, Swire Group is in focus. We heard from Cathay Pacific, their full earnings and 2020 outlook, some substantial stress that they talked about in their outlook as well. And later today, we'll be hearing from Swire names later this morning and later today. And we've got steeper losses coming through for the Swire Properties, down 3.3%. It's a similar story for Cathay Pacific, starting the day off by about 3.4%. Nancy?
Sherry, thank you very much for that. Well, let's bring in Andrew Collier, who is the Managing Director from Orient Capital Research, joining us from Hong Kong. Great to have you on the show here, Andrew. I mean, ever since we had that address from President Trump, the selling has just picked up, both in U.S. futures, but also here in Asia. I mean, we're seeing some very significant losses. Sherry just ran us through the Greater China markets, but also for the Nikkei touching down more than 4%. What do you do now as an investor?
Well, obviously, I think the Chinese markets were overestimating the ability of the Chinese government to resuscitate the economy after the virus. I think there was too much faith in the government, and now we have a situation where clearly the American government is considered relatively either inept or unable to handle the situation with the virus. So the investors who are domestic in China and those who are playing in the Hong Kong markets are saying to themselves, well, if China can't save the world and if the United States can't save the world, then obviously we're in big trouble. The real issue is what the stimulus will be in China and whether that will be effective. And I have my doubts about the degree of effectiveness of the stimulus that's likely to come in the future.
Wow. And as you're speaking, we're seeing Dow Jones implied open there move sharply lower even in the last few minutes or so, now looking at about an 800-point decline, which is already in bear market territory. So, Andrew, clearly investors are nervous. The president did stress that most Americans are at a low risk. The fear, though, as you talk about, is the fact that now that China has seemed to contain it with new cases there dropping dramatically, now they have to worry about imported cases with this going global. I mean, that's certainly what we're hearing is the concern here in Singapore as well. So what does this mean in terms of what you're expecting in the way of odds for a global recession now?
Well, I don't think it's a question so much of the imported cases into China. I mean, that's obviously a concern. The real concern for China is whether the United States is unable to stimulate the economy. And what Trump is proving in his speech is that the government is either not acknowledging the risk or has failed to have the right tools to be able to handle the risk. He's been talking about a payroll tax, which a lot of economists say is going to help corporate profits, but won't help individual consumers. So, and the fact that he cut the CDC's basically virus team when he took office is not very reassuring. So you have the domestic U.S. economy looking bad. That's going to badly impact China. So I think that's a lot of people are concerned.
So Nomura has put out a note, Andrew, this morning saying that they are expecting a targeted triple R cut from the PBOC. Would that in any way help the situation, especially with the SME sector?
Yes, of course. Anytime you increase cash and allow the banks to increase cash, that's going to help the situation. But I just did a report looking at comparing interbank and monetary policy with fiscal stimulus, and it looks like fiscal stimulus is going to be the way they're going to go. The local governments have put out a wish list of 25 trillion yuan in projects across 31 provinces, and most of which will be funded by either bank loans or bonds. And so the banks, obviously, if you cut the RRR, you can have more liquidity in the banks, and they can provide more money to the provinces. But the problem with those bridges and infrastructure investment is it takes a while to get that going. So, but that seems to be the largest share of the stimulus that we're going to see in 2020.
Right. What about the rising default risk, especially in the smaller private firms in the region? You've spoken about that in your note, talking about the ratio of cash flows to interest expense being much lower for private firms than for state firms. What kind of collateral damage can that cause?
It's very significant because the small businessman basically is the largest employer in China. And they've been cash constrained over the past 2 years because of shadow banking cutbacks. Then they got hit by the trade war. A lot of them deal with import-export in the borders, you know, in places like Guangdong and Fujian on the coast. And now they're getting this. So the Xi Jinping and the state council have put in relief on loans to small business. There's been a lot of measures that have been the right thing to do. The problem is it's difficult to get the cash in the hands of the businesses because the banks aren't really used to doing that. So I'm very nervous about that. And I think there's going to be a lot of sort of hidden defaults of small businesses, a lot of people unemployed, and that's going to affect the economy, which is why they're trying to shove bridges out the door in the provinces.
Andrew, how severe could the blow be to unemployment? Because that, of course, is going to be a top concern for the government.
Well, I mean, my attitude about unemployment is, you know, as long as it doesn't affect social stability, they'll put up with it. I mean, in the 90s, you know, about 35 million people were unemployed because of restructuring. You could have significant unemployment in China, and as long as it's in the hinterland, it's okay. But don't do it in Guangdong and Fujian and some of the more powerful provinces. There's no way around that. They're going to have to deal with it one way or another, and that's partly why I think Xi Jinping is so pushing so much for party control, because he knows a lot of the economy's out of his hands.
Andrew, great having you on the show. Always great getting your insights on this developing story. Thank you very much for your time and your insights. Okay, very quickly, the selling steepening in Asia and President Trump's address to the nation imposing a 30-day travel ban on Europe to contain the coronavirus. U.S. futures are extending losses, and that's our top story this morning. Down, last count, 800 points on the Dow Jones futures.
To keep new cases from entering our shores, we will be suspending all travel from Europe to the United States for the next 30 days. The new rules will go into effect Friday at midnight. These restrictions will be adjusted subject to conditions on the ground. There will be exemptions for Americans who have undergone appropriate screenings, and these prohibitions will not only apply to the tremendous amount of trade and cargo, but various other things.
President Trump, in an address to the nation, discussing the reasons for putting that travel ban temporarily from Europe into place with certain exceptions he did outline there. Let's show you U.S. futures, though, because far from calming the markets, we have actually seen the implied open for the Dow Jones pick up to the downside. You're now looking at 800 points, in fact, to the downside at a time when the Dow already hit bear market territory overnight. The S&P 500 and the NASDAQ looking at sharply lower opens. It is just 9:40 p.m. Eastern time on Wall Street, so we will keep a very close eye on this picture. After President Trump spoke, we also heard from the spokeswoman recently of the White House saying that due to the coronavirus, Trump has decided to cancel events in Colorado and Nevada this week. We also want to show you U.S. Treasuries, which have been moving in response to these latest developments, because keep in mind, we are seeing so many disruptions coming out of the U.S. right now. You're also seeing the 10-year Treasury yields tick slightly lower after hitting around 0.8% overnight before that address took place. And when we talk about disruptions, Tanvir, I should point out that the NBA has suspended tonight's games after a player on the Utah Jazz preliminarily tested positive for the coronavirus. This comes according to CNBC sources. And of course, when it comes to high-profile people testing positive for the coronavirus, the talk at the moment is all around Tom Hanks and his wife, who tested positive. They're in Australia, and they, in fact, were on set or have been there to film a movie that is directed by Baz Luhrmann. And there you have it, Tom Hanks taking to Twitter, describing how they were infected, talking about the fact that they tested positive, and that they will keep people up to speed day by day here. So you could almost hear this reaction, the shock and awe on Twitter when you have someone so famous as Tom Hanks come out and say he's been infected.
Exactly, so shock and awe, but the fact is them coming out and speaking about it, I think will go a long way in giving some sort of assurance to people that, look, you know, somebody as high profile as Tom Hanks got the infection, and he has, of course, updated his fans and people at large out there about how he has gone through that process of healing. So, you know, his updates will be very critical in understanding how the situation fares from here, but important that he came out to the public with his condition. Okay, let's take that story forward, especially what's happening in the bond markets, because this sell-off is not just about equities, but also the possibility of rising default risks across the world. Asmita Kulkarni is the Director Investment Strategy from FIIG Securities. She joins us live from Sydney right now to discuss more. Asmita, it's great to have you on the show. Thank you very much for your time. Put it in perspective, because so far it doesn't seem like we've really come to a point, even though credit spreads in the U.S. are widening, to say, you know, default risks are imminent. But do you see that perhaps over the course of the next 3 to 4 weeks, that could be a clear and present danger for the markets?
Hi, thanks for having me. No, look, it's interesting when we talk about default risk and what's happening with the market. We do know that there are many very leveraged households and corporates out in the market at the moment, but 3 to 4 weeks is a very short period of time. When it comes to corporate markets, you really need to look at it in two different buckets. One's the high-grade corporate market, which, you know, is seeing price uncertainty but is likely to continue and perform in the long term. And then you've got the high-yielding market, which is the market that has had a lot of credit spread moves, as well as the talk around what's happening with potential defaults. 3 to 4 weeks is a little bit too short. I think, you know, government stimulus, as well as the fact that central banks are cutting policy rates, will help those companies. But I think in the long run, the leverage will play out, and we'll see weaker players potentially defaulting. Now, there's a difference between a downgrade and a default. It is likely that we'll see more downgrades come through before there are any actual defaults where people lose any sense in the dollar.
Right, but as long as, you know, and as far-fetched as the story on demand slowdown, you know, starts to impact companies with weaker balance sheets especially, isn't there a concern that cash flow pressure will come to the fore sooner rather than later, and that will just let rating agencies reassess whether or not these companies will be able to service their debt liabilities?
Yeah, and that's definitely a very clear threat, whether it's a present threat. It seems, we have a bit of time because a lot of companies do tend to have a stockpile of cash. They tend to have access to bank lines that they can draw upon as long as they're meeting certain covenants. So it really comes down to fundamentals, right? So you need to look at what the company is doing, whether you are comfortable with the fundamentals of the company, whether you're comfortable with the sector. There are certain sectors that are under threat at the moment. So you've got, for example, the insurance industry or travel, airlines, etc. So those companies are under a little bit of pressure, and as you said, yes, we've got a bit of a double whammy with supply as well as demand shock at the moment. So the short term, I don't think there will be many issues that we'll see, but it will play out in the long term, just as cash flow comes under pressure. But while companies have cash and liquidity to be able to meet their interest repayments, I think for the short to medium term, we should be okay.
Asmita, how concerned are you, though, about the high-yielding sector's exposure to oil and gas, given what we've seen with the huge move lower in oil prices?
Oh, absolutely. That is an industry that has come under a lot of pressure. We had coronavirus-led issues, supply, demand, and then on the weekend with OPEC, Saudi Arabia, and Russia, oil price move downs have really put a lot of pressure on that U.S. shale market. The companies that are in that sector, I've heard one or two names where there is likelihood that they will suspend interest payments on their bonds. They will not be paying coupons before they enter Chapter 11 bankruptcy. So that is more of a present threat, and the longer this continues, the more we'll see companies coming out and potentially entering Chapter 11 bankruptcy. But that is a very secluded part of the market. It is the oil and gas market. From what we've seen in the U.S. credit spread markets is that the credit spreads around oil and gas have been moving out a lot compared to what the other sectors are doing. So yes, oil and gas under pressure, and the fact that oil prices have moved down so significantly and so fast is definitely not a good sign for these companies that were already highly leveraged.
NYMEX and Brent moving lower by another 4%, in fact, as we speak. Asmita, I wish we had more time. Unfortunately, we have to go. Thank you so much for joining us. That is Asmita Kulkarni there from FIIG Securities. Still to come on the show, Australia's Finance Minister, Matthias Cormann, joining us next to talk about the government's own $11 billion stimulus package to help its economy. The ASX extending a sell-off, though, this morning. Keep it right here on CNBC as we bring you all the latest market action. Welcome back to Street Signs. Well, the Australian markets, like many across the region, are deepening their sell-off this morning. Overall, the market is off almost 5%. This even as the government has unveiled a multi-billion-dollar stimulus package to buffer its economy from the virus. Well, let's get straight out to Will Kalouris for more. Will.
Good morning, Nancy. That's exactly right. $17.6 billion package, a lot of it front-loaded to before June 30, $11 billion of that with the hopes of really stimulating the economy. And joining us now to discuss the measures introduced by the Australian government today, very pleased to welcome the Minister for Finance, Matthias Cormann. He's joining us live via satellite in Perth. Thank you so much for joining us, Minister. Just firstly, I wanted to talk about the impact of the package, $11 billion to come before June 30. Are you confident, though, that this is enough to really shore up any kind of risk of a recession occurring in Australia?
Well, I mean, the package that we've put forward is about 0.9%, represents about 0.9% of GDP growth. And so, you know, it's a pretty significant package, but it is scalable. I mean, if more was to be required, depending on how the situation evolves, we would be able to scale that up. But I mean, it is a very significant package initially to support business, stay in business, to support Australians keep their jobs, and indeed to provide targeted support to Australians receiving various forms of welfare payments.
Now, overnight we had the German Chancellor Merkel saying that basically 70% of the population there could get impacted. I've seen some modelling from the government here in Australia that's suggesting that up to around 75% of our workforce could be affected. Just how much room do you have to further stimulate should the issues get worse in terms of the virus impact here?
Look, we've been working on the basis that this is a pandemic for a number of weeks now, and we've been preparing on that basis in terms of preparedness of our health services, and we provided an additional $2.4 billion yesterday to boost our health services preparedness. And indeed now today, the economic stimulus announcement, because, I mean, we understand that this is going to be a very significant economic challenge as a result of a health shock. You know, we have provided a very significant initial response if more is required. I mean, we do, because we have worked so hard over the last 6.5 years to repair our budget position, returning the budget to balance, we are in a position to do more if more is required.
Now, the idea's been bandied about in terms of perhaps issuing a moratorium on the superannuation payments. That could be an injection of cash without necessarily needing to have the government spend any kind of money. Is that something that you'd consider?
Well, look, I mean, we've been very focused on providing tax relief to business to encourage and incentivize increased investment by, for example, expanding the instant asset write-off by, you know, as long as businesses invest more by 30 June 2020, they'll be able to immediately deduct up to $150,000 investments for businesses with a turnover of $500 million a year. We've also, of course, provided cash flow support, and we're providing direct support to Australians on various forms of welfare payments. You know, it's a very straightforward, it's a simple approach, but it's a very effective approach. It's a scalable approach. I mean, the measure that you mentioned would, I suspect, create a level of controversy at a time when we need all Australians to pull together in the same direction.
Minister, when you mention that you stand ready to do more if needed, can you give us a better idea of what it is that you're looking out for that would trigger additional stimulus? Is it a certain dent to the economy that would be worse than you currently anticipate, or further spread of the virus? What would it take to have to put forward even more stimulus?
Well, we've been acting on advice on what the expected impact of the spread of the coronavirus is likely to be economically on the Australian economy and economic growth, you know, in the March and June quarters. Obviously, there's a lot of uncertainty around all of this as to how long it will take. You know, I mean, we don't really know, you know, how long we're going to be dealing with this. So, I mean, we expect that further decisions are likely to be required, but we can only act on the best available information in front of us. And right now, that's what we've done. As the information becomes better and clearer, and as we, I guess, reach the peak of the epidemic and get some sort of better read on where this is headed economically, we might be able to recalibrate further.
Right. But Minister, good morning. Tanveer also joining into this discussion. Do you think the recession risk is something that you will have to face inevitably, given the fact that there's been such immense pressure on travel and trade that despite your best efforts, a technical recession is still something that you might have to face sooner rather than later?
Well, our focus is on keeping the Australian economy growing. We are into our 29th year of continuous growth. We went into this challenging period in a comparatively strong economic position and in a stronger fiscal position as a result of the work that we've done over the last 6.5 years. But moving forward, we'll just continue to make the best possible decisions in the circumstances to support business, to support working Australians, and to give ourselves the best chance for the strongest possible recovery on the other side. Because what we do know is that this is going to be a temporary challenge. We don't know for how long, but we do know that it will be a temporary challenge. And the fundamentals in the Australian economy are strong, and we are working to maximize the opportunity for the strongest possible recovery on the other side.
Now, Minister, we actually saw consumer confidence drop to a 5-year yesterday. In this plan today, you've basically afforded a lot of money towards low-income earners to really generate some kind of consumption and impact. Do you think, though, that perhaps the middle-income earners that aren't getting any kind of support aren't going to view this very favourably at all?
No, I don't believe so. And look, we've provided $300 billion worth of income tax relief in our last 2 budgets, and disposable incomes in the final 6 months of the 2019 calendar year have grown at the fastest rate in about 6 years. So, I mean, and I think that Australians understand that this is a time when we all have to pull together. We're facing a significant economic challenge. We are providing significant support to business to keep working Australians in jobs, but at the lower income end and at the income supported end of the spectrum, I think that all Australians understand that there are particular challenges, and indeed the stimulus at that towards that segment of the population is economically particularly effective.
Minister, thank you so very much for your time. It's been an absolute pleasure. That's Minister Cormann, the Finance Minister of Australia, on the coronavirus stimulus package that the government has announced. Tanveer, back to you.
Thanks very much for that, Will. Clearly, the Finance Minister in Australia confident that they are ready right now to take all necessary measures to combat the situation and perhaps the economic fallout of this health crisis in the region. Lots more in the second hour of Street Signs lined up right here. Indonesia is next to join the Asian Trading Day, and so far, it's not looking pretty. We'll get you the latest from that market when we come back in 2 short minutes.
is CNBC Breaking News. Market sell-off.
Another day of market mayhem. Very good morning to all our viewers. You're watching the second hour of Street Science. I'm Tanveer Gill.
And I'm Nancy Hungerford. Let's get straight into your headlines this hour. U.S. futures are down sharply as President Trump's coronavirus measures fail to ease investor concern. Trump says he will suspend all travel from Europe for a month and provide more liquidity for small businesses.
I am instructing the Small Business Administration to exercise available authority to provide capital and liquidity to firms affected by the coronavirus.
Australia says it will deploy $11 billion of stimulus before June to soften the blow of the outbreak on the economy.
Because, we understand that this is going to be a very significant economic challenge as a result of a health shock. We have provided a very significant initial response if more is required.
ECB's boss, Christine Lagarde, facing the big test to persuade policymakers that a decisive response is necessary to tackle the economic fallout following the coronavirus outbreak. Euro-dollar hovering near the 1.13 handle ahead of that ECB decision later today.
Big market sell-off gripping Asian markets all across the board right here at the top of 10 for Street Science. We're looking at the Australian market. We just touched base with the finance minister in Australia talking about that stimulus and how that's required to support the economy given the challenges that it is facing, but not enough to support the markets there. 370 down on the SX 200, down about 6.5%. And look at the fall in the Nikkei 225. That's down 1,000 points. That's a slash of about 5% coming in for that major market. For the China markets, relative resilience, so to speak, though the markets are down in excess of 1% as well. For the benchmark indices there, Hong Kong markets are down in excess of 4% as well. And we're looking at Straits Times back home right here in Singapore, also staring down the barrel nearly 4%. The Kale Composite down about 1% as we speak. But suffice to say that there is a lot of pressure building in this part of the world. To the Forex space, and very quickly take a look at what's happening on the major Forex equations. We're looking at the GBP actually now at a level of 1.28, but I want to quickly mark the climb down for the US dollar, 96.20 coming in for the greenback there. And for the other major movers, you're looking at a level of 103. And this talks about heightened risk aversion in the markets for the Japanese yen, 103.45 coming in there for the Japanese currency. And for the Aussie dollar, we're staring at a level of 64 cents. Very quickly moving on to US Treasury yields, because we saw a sharp sell-off there too, especially an ease in yields coming in there for the 2-year 0.44. This is the one that you need to monitor. Down 8% for the benchmark yield there, 0.75. We started this show with a level of 0.8 plus, so there's been a major reset there. And for the 30-year Treasury yield, we're staring at a level of 1.26. Very quickly to the oil market, because that's getting even more sensitive to what's playing out in the world. 31.1 last count for NYMEX, down 5.5%, selling intensifying there as well. 33.91 coming in for Brent, down about 5%. And for gold, well, we've not seen a major meaningful move to the upside, drawing a flat line at 1634. To the U.S. futures then, Nancy.
Yes, indeed. The story of the hour, you could say. Let's give you a fresh check on U.S. futures, because we are seeing extended moves to the downside. Wow, look at that. The Dow Jones with an implied open of more than 1,000 points. And this is significant because not only are we already in bear market territory for the Dow, the S&P 500, the NASDAQ are ever so close to bear market. But when we started this show just about an hour ago, it was closer to around flat for these futures just before President Trump started speaking. So as you can see, investors are clearly nervous. And since that address, we should also note we've seen further disruptions coming out of the U.S., the NBA canceling their season, the White House noting that President Trump will cancel some key events this week, including one in Colorado. So clearly that anxiety is playing out in the markets, and this story is evolving as we speak. So let's tell you more about that address from President Trump this morning, where he did announce that the U.S. would be suspending all travel from Europe for the next 30 days. And the restrictions will apply to all people and goods traveling from Europe, but the UK will not be affected as of now. Trump also rolling out a number of measures to help the local economy weather the growing threat from COVID-19.
Effective immediately, the SBA will begin providing economic loans in affected states and territories. These low-interest loans will help small businesses overcome temporary economic disruptions caused by the virus. To this end, I am asking Congress to increase funding for this program by an additional $50 billion. Using emergency authority, I will be instructing the Treasury Department to defer tax payments without interest or penalties for certain individuals and businesses negatively impacted. This action will provide more than $200 billion of additional liquidity to the economy. Finally, I am calling on Congress to provide Americans with immediate payroll tax relief.
Well, the Greater China markets have been tracking the rest of Asia lower, so let's get out to Sherry Kang, who is watching all the movers for us. Sherry, what's the damage report?
So, well, certainly the joining of a sell-off is continuing in the Greater China markets, and all sectors are out of money in Shanghai, Shenzhen Composites, as well as the Hang Seng Index. As you can see, Hang Seng is the biggest loser there, down about 4.3% as we speak. So that spread is certainly playing out. When it comes to the currency world, a dollar jumping against the Chinese currency, CNH and CNY alike. So again, really that 6.97 handle has been achieved once again. In the meantime, here in Hong Kong, the Hang Seng Index, like I said, down as much as 4.5%, and now it's getting very close to the bear market territory, off as well close to 20% from the highs of April 2019 as well. So we'll keep an eye on this particular index. In the meantime, we're talking about the NBA season suspended until the further notice, and there are a couple of stocks with that exposure to NBA here in Hong Kong leading, as well as sports products actually continuing the sell-off as well. In the meantime, over in Taiwan, interesting lines that we got from Taiwan's central bank this morning, talking about how there is that rate-setting meeting next week, and certainly we'll keep an eye on this, and also talking about how fiscal policy could be more effective than monetary policy. So certainly doing that balancing act. In the meantime, TAIEX now sharp drop, down 4.7% at the moment. Tanvir?
Thanks very much for that, Sherry. Australia's ASX 200, one of the biggest losers in Asia this morning, despite the government stimulus to combat COVID-19. And Will, as I come across to you, this has been a 7% drop, the lowest since late 2016. And we were discussing this earlier in the morning as well, the fastest run into bear market territory for the Australian markets.
Exactly. And right now, we're off by around 7.5%, the biggest loss that we've seen basically since the GFC. And the GFC was 8.3%. That was the biggest one-day close of a loss. The only time we've ever had a bigger loss than that was during that 1987 crash, where we lost around a quarter of the market. So this is somewhat significant if we do keep trading at these levels, or even fall even lower. As you can see there, 52.92. You've got the Australian dollar also taking an absolute beating right now. It's at 64.50. And like you did rightly mention, this is on a day where we've just gotten a $17.6 billion stimulus package from the Australian government. Granted, a lot of this selling did come after President Trump over in the United States basically initiated that travel ban for Europeans entering into the United States, but at the same time we were already down by around 4%. And just to get you across just how broad-based this selling is, let's take a look at the banks first, because they're getting absolutely pummeled, and this is after perhaps dropping off by around 20-25% over the past 30 days or so. As you can see right there, the ANZ off by 6.5%, CBA 6.5%, National Australia Bank and Westpac all firmly lower. Even where you'd expect to find some respite perhaps in terms of the iron ore prices, you're not finding that in terms of the materials plays, because they're all significantly lower as well. So let's take a look at the iron ore plays right now and how they're tracking. Fortescue 9%, Rio Tinto 7%, BHP 8%. So this is a really interesting day for the Australian market. And if we have time, I'd like to get you across Australia's energy plays as well, because as a sector, they're off by 10% today. It doesn't necessarily remediate with the price of oil that we're currently seeing as well. Woodside sub 20 at 9% off. Oil Search down below $3. It hasn't been that low for a considerable amount of time. It's at 10.3% lower. And then you've got Beach Energy and Santos 10% lower at 418. It's a very, very bad day for the markets, Tambi.
Yep, and it has been actually a bad month for the markets as well. Thanks very much for that, Will. All major U.S. indices ending the session lower overnight, the Dow entering bear market territory after the World Health Organization declared COVID-19 health crisis, that is, as a pandemic. U.S. financials, energy, industrials are all now in bear market territory as well. As markets search for direction, Allianz's Mohamed El Erian says we will need to hear strong, decisive action from policymakers.
The concern you have is you don't want a feedback loop. The economy disrupts the markets, and then market malfunction disrupts the economy. We don't want that second loop, because if that second loop kicks in, and I really hope it doesn't, but if it kicks in, it's going to make things a lot harder for policy to act as a circuit breaker. And we're all looking for policy to act as circuit breakers.
Indeed, indeed we are. Whether it will work is the question. Well, let's bring in James Chio, who is the Chief Market Strategist for Southeast Asia at HSBC Private Banking, and he joins us here at the SGX. James, great to have you on the show. I have to say it is pretty unbelievable to watch what we are seeing at this moment with U.S. futures and Asian markets moving sharply lower. I mean, 7% for the ASX after Australia comes out with a pretty substantial stimulus package. And this hits at exactly what Mohamed El Erian has been warning about, that even if central banks and fiscal authorities throw stimulus at the problem, that it might not work this time around in terms of market sentiment. Does that concern you?
Well, it's really a tug of war. The real issue is a supply side and demand side disruption associated with COVID-19, and that's really hard to predict. So policy measures, particularly fiscal policy or even interest rate cuts, do not address directly to these issues. You really need coordinated health policies and health authorities to actually stem this, contain this rise in COVID-19 cases.
And you're saying we haven't seen that yet. I mean, President Trump is talking about support for small businesses. They're talking about, they've already put through some measures in terms of helping the health sector. We've seen similar steps around the world, but you're saying show me more? As an investor, you want to see more?
Well, it's still early days in this whole situation. I mean, we need to see tighter measures globally to contain this till we see some stabilization. But as of now, I think it's still early days in this situation. And therefore, because of this uncertainty associated with this huge demand shock, and it's largely fear and panic that started in the real economy seeping into the financial markets. And this whole relationship, it's going to be extremely volatile in the days ahead.
So you think there's no escaping the situation right now in terms of arresting the risk sentiment that there is out there? Because President Trump is saying, look, Asia is healing, Europe is in a spot of bother, and that's why they are issuing that travel ban against Europe. Does that mean that maybe a few weeks down the line, once the pandemic curve, and especially the epidemic curve in the Western world peaks and flattens out, that there would be some sort of semblance and return of sanity in the markets?
I think in the short term, what central banks or even fiscal authorities can do is to go hard in terms of easing to sort of restore some sentiment back to markets, and that they can do. But ultimately, what the real condition is to solve that problem of COVID-19, and I think you really need health authorities to be very tough.
So it really boils down to the number of cases.
Yes, that's right.
I mean, as the number of cases peak out, that's the only assurance the market can get. So these fiscal measures, these monetary policy measures that are being announced, you think they don't do the job?
Well, it can actually help sentiment, but ultimately you really need the cases of the condition to start to improve.
James, the trouble is in the process of doing that, I mean, you have to go almost ultimate containment. That seems to be a step closer to what the U.S. is doing with this travel policy regarding Europe. But then it's the shock and the fear that spreads to consumers when you do that. So even at the same time that President Trump is reminding everyone that the risk to most Americans is low, which it is, the risk is really to elderly or those who are sick, they're doing things like reducing travel, discouraging travel. The NBA has canceled an entire season. I've seen universities, including my own alma mater, cancel classes for the time being, and this has such a strong psychological effect. So the question then becomes, how can the economy recover even once those cases do subside?
Well, it's really a combination of supply-side shock, because once you do containment, it's really a big supply-side shock in which you shut the whole place down for a period of time. And thereafter, there is fear, as you said, and that demand shock is really hard to predict. Whether will people start to spend even though of this whole virus situation? So it's this combination of fear in the demand side, and of course the supply side is a very tough decision for authorities to make. And I think this is actually playing out in markets right now.
So what are you doing in the markets?
Well, I think at this stage, it's really, I don't think we're at the bottom yet. It's going to, downward risk is still going to be very strong. There's going to be lots of uncertainty. So markets are going to be on a roller coaster ride. On one day, you're going to get a sell-off because of this issue. Next day, you get policy action and you get a bounce back up. So I think the best strategy really right now, it's really to diversify across asset classes. Too early to add aggressively to risk. You want to be a bit more positioned defensively.
Right, but you're saying find solace in gold, so you're overweight on gold. Now, I just want to bring up the 1-month chart on gold to reflect the kind of gains that the yellow metal has showcased for investors at a time when the markets have been melting away. So what has it done in the last 30 days? 4%? Overlap that with what the S&P 500 has done over the course of the last 30 days, and bam, we're seeing a significant sell-off there for the Dow Jones and the S&P 500, which is to the tune of 20%. In fact, beyond that, because we're now in bear market territory. There is a sense in the market that the upside to gold is capped because people are liquidating their positions in gold right now to actually service the margin calls that are getting triggered in the equity markets, and that is not a good sign.
Well, at this stage, it's very important to have risk mitigation or risk management in portfolios right now. Gold still has a place in it, but there are other tools as well. You can use option strategies, etc. And of course, treasuries is the safe haven of choice right now, as we've seen. So there are various ways. Gold is one of them, and of course, in this very uncertain markets.
Aren't you worried about that? Aren't you worried about the fact that, you know, because that will be the last straw where people in the demand for cash to honor their margin calls actually start liquidating their gold positions?
Well, in this market, if you put in context that the stock market actually risen a lot and very strongly, so there are leverage that's built up. And in some ways, there is, of course, a correlation between asset class. But I think generally, if you take a long-term view, gold will always be a safe haven of choice.
And James, just as we're rounding out those markets that are already in bear territory, including the Dow in the U.S., now Indonesian stocks, which have recently come online, officially entering bear market territory. They are down, in fact, 22.3% since that January 15th peak. On the session alone, the Jakarta Composite is off some 4%. So we are really seeing indiscriminate selling across the region today, Tanvir.
Yeah, that indeed is the case. The Indonesian market, very quickly, James?
Well, I think Indonesia market is going to be extremely volatile. It's headwinds associated with oil price, etc. Indonesia has big exposure there. So I think from that perspective, we have actually reduced our weightage in Indonesia on an equity portfolio basis, so reflecting these volatile times.
Okay, James, stay on with us. Lots more to discuss with you as we go along on the show. But we have more markets and analysis for you after this. Asian stocks stay deep in the red. As we head to a break, here's a look at the biggest losers in South Korea. Breaking it down for the region and for the markets in specific, all deep in the red. Come back in 2 minutes.
Welcome back. Let's give you a fresh check here on the markets. I want to focus in on the Nikkei 225 because we are seeing it at its lowest level since April of 2017 now. Yes, the market overall is off some 4.6%, and we've seen just sharp drops for these major markets, especially for the Japanese market and the Australian market now, which is off some 5.4%. But also in Southeast Asia, we just told you the Indonesian market is in bear as well. So let's talk a bit more about Japan, because as we watch the strong reaction for the Nikkei 225, we're hearing comments from Japan regarding the Olympics. And as you can see right now, the spokesperson says there is no change in Olympic plans. Earlier, we did hear from the Tokyo governor saying that the change from the WHO on moving the status to the virus is an issue that they are looking at, but talked about the fact, too, that they are not considering canceling the Olympics at this stage. Japan also talking about the fact that they are not considering a state of emergency as of now. Of course, there's a lot of anxiety and concern among people in Japan as it pertains to the virus, but also among investors watching this reaction in the markets. Let's get to James Chio now from HSBC Private Banking. James, just give us your view on the Japan markets first here.
Well, I think it's going to be very difficult at this point of time, really, because in this sort of uncertain times, the Japanese yen strengthened, and that's a headwind for the Japanese equity market, especially the exporters. So it's going to be tough this time round, and particularly as well, I think the key issue is really now a global containment of the COVID-19 situation. And Japan, definitely, I think investors are watching how they handle the situation there.
Right, but there is all that talk that by the time the Olympic schedule comes underway, that things will be sorted. And so the Japanese government does not want to jump ahead of the curve or jump ahead of that event risk really playing out to see how the situation fares from here.
Well,
in the run-up to that event.
Yeah, well, it's still fluid, and lots of variables are still moving. So I think the plans are in place, but of course, everyone's just watching how the situation develops.
And James, as we look to travel across the region, getting some fresh news from China's aviation regulator today as well, saying that the total number of passengers did fall 84.5% year over year in February. On the one hand, you look at that number and say, wow. On the other hand, you say, okay, given what we know in terms of the quarantines that were across China, perhaps not a huge surprise. Nevertheless, this speaks to questions of when will we see the recovery kick in now that cases have started to abate?
Well, I think China is a case in which the containment was very draconian in the beginning. They took hard, tough measures at the start, and the situation there is actually improving, coupled with the fact that they have a big policy leeway to do, whether it's fiscal policy, easing, or even more monetary cuts. So I think that is actually a very positive factor in the world economy from that matter. So I think that's an example and something that perhaps as the COVID-19 spreads to other countries, we can see that similar type of response.
Do you think it would be this bad elsewhere in the world?
Well, it really depends on how you contain it. So I think the containment is crucial to prevent the escalation of cases.
Okay, fair enough. Just very quickly, because we're getting some comments from the central bank in Taiwan also saying that the economy will not continue to meet its 2% growth target this year. Do you see more of these statements coming out where economies in this part of the world start cautioning investors on their growth outlook?
Well, I think certainly, because I talked earlier, this is a rare scenario in which you get the demand shock, as well as in order to solve the situation, you need to cut down supply significantly with shutdown. So definitely there's going to be a wide range in outcomes and definitely largely on the downside, at least for the short term.
So right now the market is not even though credit spreads in the US have widened, right now the market is not pricing in a high risk of defaults coming through. But for the airline sector, right, the main cost base is aviation turbine fuel, which is down, so they have some cushion there, but also the lease agreements that they enter into for the long term. If cash flows come under pressure, do you not think that those lease agreement payments will come under question, and airlines, tourism, hotel, real estate, those sectors will come under pressure in this part?
Well, I think sectors associated with tourism are definitely at a head. So, of course, oil price drop is a boost for some of the travel industries, particularly airlines, cruise, etc. But ultimately, you really need the demand, that fear to subside, and then the resumption of activity back to normal. But as of now...
So, but are you pricing in a default risk in these sectors? When we're talking about oil companies in the US, but the other related sectors which are directly hit, is there rising risk of defaults there?
Well, the situation is still volatile. It's hard to really predict, but of course the risk is of course on the rise given how volatile markets are, and that could actually force that increase in the probability.
I mean, I know we're talking about oil with regard to credit risks as well, but looking at that fall now in Brent and NYMEX, just as the last 30 minutes or so, picking up to the downside. Brent crude off 6.6%, NYMEX crude off 6.6% as well. It's really hard to see where the story goes, James. I mean, do you have any expectation as to when we'll see the bottom in oil prices?
Well, it's hard. I think as of now, it's still going to be extremely volatile, and it's largely going to trade around this levels, really, because first demand is collapsing, and on the supply side there is no cuts whatsoever. But at this price, really, ultimately you really need an improvement in the COVID situation, and that would shift.
Do you think at this price too it will force Saudi or Russia or perhaps both of them to blink?
It's still too early days, but of course if markets continue like that, there's going to be a lot of pressure for all countries.
Yeah, no, all countries, but given the cost of break even being lower in Saudi Arabia across the board, there might be perhaps more leverage that they have in those negotiations or the breakdown of talks. But that's the performance. I just want to circle back to the Indonesia story. Because if it's really the COVID-19 situation, which is scaring world markets and world economies, Indonesia has reported the least number of cases, or in and around, has lower cases to report so far, and it's a domestic-oriented economy, and yet the fall has been so significant there.
I think first and foremost, Indonesia is a high beta market, so when there's a global risk aversion, typically Indonesia doesn't do very well. And the currency, likewise, a high beta currency. So I think a lot has to do with global risk aversion, but also I think that oil price fall, to me, is a real issue because Indonesia has a huge exposure to it. So I think Indonesia is taking that hit from that perspective.
Yeah, and when it comes to oil importing nations, we've heard a few voices say, oh, look at economies like India that are going to benefit from this move. Can anyone really benefit if you're saying the primary cause is the fear over the demand coming from the coronavirus?
It's very hard to say. There are, of course, long-term structural winners from this. Obviously, consumption has to continue, but the way of consuming is different. Probably online consumption, e-commerce, I think those would do well over long term. Short term, yes, downside risk, lots of volatility, but I think those trends, online consumption, online entertainment, etc., I think those things would play out very well, structural themes in long term.
Well, in India, I'm picking reports that their import bill will half, of course, with this
But
fall
if
in prices.
globally you're looking at a recession, does that help?
You need producers to be viable for those supplies to be actually honored.
James, so good to have you. Thanks for working through all the breaking news with us. We do appreciate it. That is James Chio of HSBC Private Banking. And still to come here on the show, the yen strengthening sharply amid the sharp declines in the equity markets. We will get you across all the currency moves coming up next and find out what the Fed is likely to do next week. Stay right here. Welcome back to Street Science, and we are tracking another major sell-off at this hour. You are looking at U.S. futures pointing to a very sharp move to the downside. The Dow Jones with an implied open of more than 1,000 points, and the reason this is so remarkable is that we already have the Dow in bear market territory as of last night, following another more than 1,000-point drop stateside. The S&P 500 and the Nasdaq looking at sharply lower opens. We will caution it is early stateside. It is just about 10:30 p.m. Eastern time in the evening still, so this story could change before we get to the open. And we've seen the moves go sharply lower ever since President Trump did unveil more information in terms of support for small businesses, talking about the payroll tax. But the big headline there was the suspension of travel to Europe for 30 days, and that does seem to have spooked many in the markets. Let's check in on U.S. Treasury yields. We are tracking a little bit move lower, I should say, in the 10-year, across the curve now, in fact. So you're looking at the 10-year yield at 0.7649%. But keep in perspective where we were in that Monday equity sell-off. We saw the 10-year closer to almost 0.3%, so a lot of buying into treasuries at that stage. Let's show you the Forex majors as well, with a focus here on the dollar index. As you're looking at treasuries, the U.S. dollar index is dipping by about 0.3%, and the U.S. dollar against the Japanese currency is the real mover on the session. You are looking at a 1.1% drop for the greenback against the Japanese currency. We are back just above that 103 mark at 103.33, so this is very much a part of the story of money flooding into safe havens. Tanvir?
Yeah, I think what the market will be watching out for very closely is clarification coming in from President Trump on that restricted travel from Europe. Does it only pertain to people, or is it people and goods? Is it essentially a travel restriction, or is it a trade restriction as well? So I think that ambiguity is causing some tensions as well in the market.
Apparently, the president has said the trade in no way will be affected by that 30-day restriction. Sure. So the idea is that it's people, not goods. And we've heard from those in the shipping industry that they don't think there is a risk to any transit of goods. So that would make sense if the fear is virus containment. So this would be applied to only people. The other question I have is, why exclude the UK? Because given all the travel that takes place between the UK and continental Europe, that is a bit of a surprise.
So I think there, he's just purely going by the numbers. Because Italy and some of the other major economies in Europe are seeing higher cases, he's perhaps secluded the UK from that travel ban. But I think it's a very important aspect to focus on, because if the market were to believe that this was only a travel ban, you could have seen some respite coming in the futures performance. But it seems like the concern is still very much on the market's mind.
So Trump is on Twitter, apparently, saying the restriction stops people, not goods. And if we can just bring up U.S. futures to see if there has been any reaction to that, to your point, Tanvir, about travel versus goods. But President Trump is saying very clearly that this restriction stops people, not goods. It does seem as though, based on the market reaction, that element of his address could have been responsible for some of this.
Yeah, but what if people are traveling for official purposes, and what if the travel is associated with trade? It's very difficult to separate the two.
Yeah. I mean, well, we've seen that impact play out in Asia, right? I mean, unofficially, without travel bans, hardly any U.S. executives from big companies are traveling out to Asia more broadly, not just China, of course.
So I think it's very difficult to separate the two, and perhaps that's why the market feels that net